Amazon doesn't really sell products anymore. It sells dependency. Millions of businesses rely on Amazon to reach customers. Competitors rely on Amazon's service to keep their companies online. Consumers rely on Amazon to make everyday life feel frictionless. And the unsettling part is, most people still think Amazon is just a website. That misunderstanding helped create one of the most powerful corporate systems in modern history. A company that didn't dominate markets by openly breaking the rules, but by learning how to operate directly along the edge of them. Because Amazon didn't destroy competitors the way monopolies used to. It made them dependent first. At the surface level, Amazon looks like the greatest retail success story ever built. An online bookstore that expanded into electronics, groceries, streaming, healthcare, logistics, cloud computing, and AI infrastructure. Consumers loved it because it removed friction from life. One click. Next day delivery. Done. But hidden underneath the convenience was a business model traditional retailers could never realistically compete against. Because Amazon wasn't behaving like a normal retailer. For years, analysts noticed something strange. Amazon's retail division generated enormous revenue, but profits were razor-thin. Sometimes almost non-existent. That should have been a problem. Retail companies are supposed to make money selling products. Amazon often didn't. At least not from retail. The real engine was AWS. Amazon Web Services. The division most consumers barely think about. AWS launched in 2006 and quietly became the backbone of huge sections of the internet. Netflix, Airbnb, government systems, enterprise software, startups, streaming platforms. Massive portions of the digital economy began running on Amazon servers. And AWS became wildly profitable. In several years, AWS generated most of Amazon's operating income despite being a much smaller share of total revenue. That changed everything. Because Amazon's store no longer needed to operate like a normal business. Traditional retailers had to survive on retail profits. Amazon could survive on infrastructure profits. Which meant it could afford lower prices, faster shipping, bigger warehouses, more losses, more expansion. Competitors thought they were fighting a store. They were actually fighting a company subsidized by the internet itself. And Amazon used that advantage aggressively. In the late 2000s, a company called diapers.com was growing rapidly online. Parents loved it. The business specialized in baby products and was becoming one of the biggest independent e-commerce success stories in America. Then Amazon noticed. According to reports from the time, Amazon dramatically lowered diaper prices. Analysts estimated the company was losing money on some sales just to stay cheaper than diapers.com. Parents thought they were getting better deals. What they were actually watching was a billion-dollar war. Diapers.com couldn't survive the kind of pressure. Amazon could. In 2010, Amazon acquired parent company Quidsi for roughly $545 million. Years later, it shut the business down. Legally, aggressive pricing is not automatically illegal. That's what made Amazon so difficult to stop. The company rarely crossed obvious legal boundaries. It simply operated at a scale competitors couldn't survive against. And then Amazon discovered something even more powerful than underpricing competitors. It built the marketplace itself. Millions of third-party sellers flooded onto Amazon because they had little choice. That's where the customers were. Amazon controlled traffic, recommendations, advertising visibility, fulfillment logistics, and prime delivery. Businesses became dependent on the platform to survive. But according to investigations by Reuters, The Wall Street Journal, and congressional inquiries, Amazon employees allegedly accessed marketplace seller data to identify successful products and profitable opportunities. Amazon denied misuse of individual seller data and stated policies prohibited those practices. But regulators became increasingly concerned by the pattern that emerged. Independent sellers took all the risk. Amazon watched what succeeded. Then Amazon launched competing versions under brands like Amazon Basics. And unlike the original seller, Amazon controlled the ecosystem itself. Search rankings, recommendations, fulfillment costs, advertising visibility, the buy box, everything. Former sellers described the same experience repeatedly. Build a successful product, gain traction, then suddenly compete against an Amazon version appearing above yours at a lower price. A normal retailer can copy products. But normal retailers don't possess real-time behavioral data from millions of businesses operating inside their infrastructure. Amazon did. That's the moment the company stopped looking like a retailer and started looking more like a system. By the early 2020s, estimates suggested Amazon controlled around 40% of US e-commerce. Merely half. Then there was Prime. Prime looked like a subscription service. In reality, it reshaped consumer behavior completely. People paid upfront for convenience. Waiting became unacceptable. Two-day shipping became normal. Consumers began comparing every shopping experience to Amazon's infrastructure. Smaller businesses couldn't keep up. Amazon wasn't just competing anymore. It was redefining what normal looked like. And the deeper the company expanded, the more unavoidable it became. Some businesses competing against Amazon still relied on AWS servers to keep their own companies online. Think about how strange that is. A company could be losing market share to Amazon Retail while simultaneously paying Amazon cloud fees every month just to stay operational. That's not traditional competition. That's dependency. And regulators struggled to respond because Amazon rarely behaved like monopolies from the past. Traditional monopolies usually raised prices after eliminating competitors. Amazon often lowered them, at least in the beginning. That confused antitrust law for years. In 2017, legal scholar Lena Khan published a paper called Amazon's Antitrust Paradox. It argued regulators were using outdated definitions of monopoly power focused almost entirely on short-term consumer pricing. If prices stayed low, regulators assumed competition remained healthy. Amazon exposed the flaw in that logic. A company could dominate markets structurally while still appearing consumer-friendly on the surface. Especially if investors tolerated years of losses in exchange for future control. Then came reports surrounding something internally referred to as Project Nessie. According to documents reviewed during regulatory investigations, the system allegedly analyzed opportunities to raise prices after competitors disappeared from certain market spaces. Amazon disputed interpretations of the project and denied wrongdoing. But the allegation revealed something important. Low prices may never have been the destination. They were leverage. Because Amazon's real goal wasn't simply selling products. It was becoming the infrastructure modern commerce moved through. Shopping, shipping, advertising, cloud computing, logistics, AI. The company embedded itself so deeply into everyday life that leaving the ecosystem became increasingly unrealistic for both businesses and consumers. And that's why Amazon became so powerful. Not because it illegally destroyed every competitor, because it built a system competitors slowly realized they could no longer survive without.
Dark Pool investigates the systems operating beneath everyday life, the institutions, incentives, and structures most people never think to question. The systems shaping the modern world rarely announce themselves. Because the most powerful systems are usually the ones nobody looks at closely.